Welcome back to the Deep Dive. Today, we are undertaking, well, a really deep exploration into the heart of global e-commerce.
That's right. We're looking at the intense and I'd say increasingly complex rivalry between China's two heavyweight tech giants, Alibaba Group, that's BABA, and JD.com, or JD.
And this isn't just, a simple business competition anymore, is it?
Not at all.
Yeah.
It's really a high-stakes battle.
Yeah.
You've got two fundamentally contrasting operational philosophies, different corporate structures clashing.
Okay.
And we've pulled together a pretty comprehensive stack of sources here. We're covering their latest financials, strategic moves, those dramatic Q2 2025 earnings.
Which were quite something.
Oh, yeah. And the structural changes, plus all the external pressures, competition, regulation that are forcing these rapid, sometimes quite painful strategic pivots.
Okay, so let's try and unpack this for you listening. Our mission today, really, is to give you the blueprint. Help you understand the core decision facing investors right now.
Exactly. Are you betting on JD.com? Which looks like, a deeply discounted, operationally super efficient engine. Kind of a value play.
Right.
Or are you taking that high leverage growth bet on Alibaba, banking on its, let's call it structural profitability potential, which is now being fueled by this very aggressive, very capital intensive push into new areas like AI and the cloud.
It's fascinating because these external forces you mentioned, new competitors, regulatory hits, they've really shattered that old, comfortable duopoly they had.
Completely Pinduoduo, Duian, they've changed the game.
So both Baba and JD are now having to defend their turf, but in wildly different ways.
And those defenses are costing billions. Billions. We really need to understand exactly what each company is sacrificing and, crucially, what they're betting on for the future.
Right. Let's start at the very beginning then, because this whole structural difference, it's absolutely key to understanding everything else, their financial profiles, the risks.
Fundamentally key.
We often describe Alibaba as the asset-light platform and JD as the asset-heavy retailer. Can you break down how those labels really define how they make money and maybe more importantly, their risk profiles?
Yeah, the difference is foundational, really. Alibaba, think about its big marketplaces, Taobao, which is consumer-to-consumer, C2C,
Right.
and Tmall, business-to-consumer, B2C. Alibaba operates primarily as, well, a sophisticated digital landlord, an intermediary.
Like a giant digital shopping mall owner.
Exactly like that. They own the mall, not the shops or the inventory inside. They don't typically buy or hold the stuff that's sold on their platforms.
Okay, so if they aren't actually selling the products themselves, where does the bulk of their money come from? It must be substantial.
Oh, it is. It comes from high-margin service revenue. Things like service fees for merchants, commissions when a sale happens, advertising, huge part of it, merchants paying for visibility.
Makes sense.
And also data services, helping sellers optimize their shops and strategies.
Yeah.
Now, this model, it's inherently designed for potentially spectacular profitability leverage.
Right.
Why? Because they aren't tying up vast amounts of capital in physical inventory or warehouses.
Less capital expenditure.
Much less. It frees up capital.
And their logistics arm, Cainiao Smart Logistics, that perfectly mirrors this asset-light idea, right? How's that different from, say, a traditional delivery company?
Cainiao is essentially a network integrator. It's built on this incredibly vast, intricate web of thousands of external partners, delivery companies, local couriers, warehousing providers,
Okay.
all stitched together by Alibaba's data platform and technology. They minimize the capital needed for physical things, for infrastructure. Instead, they focus on data intelligence, integration, coordination. That's how they achieve scale.
Right.
And this lack of owned fixed assets is the core reason why, if you look back at our sources, say in a more stable competitive time like 2021.
Before things got really messy.
Exactly. Alibaba generated an astonishing 10 times the net profit of JD.com. 10 times.
Wow. Despite having only roughly double the revenue.
Roughly double the revenue, 10 times the net profit. That 10x ratio, that's the spectacular high watermark. It shows you the incredible financial leverage possible with that platform model when conditions are right.
That profit multiple is it's incredible. Okay, now let's flip the coin. JD.com, the asset-heavy retailer, they seem to embrace the exact opposite philosophy. Control, 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 even if it costs more.
That's a perfect way to put it. JD is essentially the opposite structure. Fundamentally, they are a true retailer. They use the direct sales model, sometimes called 1P or first party.
Okay, 1P. What does that mean in practice?
It means they take on the risk. They take on the investment of actually purchasing and owning the inventory before they sell it to you, the end consumer. They control the entire supply chain, end to end. from the moment it hits their warehouse shelf right through to the delivery truck at your door.
And that control, that's their famous competitive moat, isn't it?
Yeah.
People trust JD for guaranteed authenticity, super fast delivery, easy returns, all because they own the whole process.
Precisely. That end-to-end ownership, inventory management, warehousing, delivery fleets, that's what builds their reputation. Reliability, quality, speed. Their revenue, therefore, is overwhelmingly dominated by product sales, just the hard cash generated from moving inventory they own.
And JD Logistics? JDL.
JDL is the physical manifestation of this whole strategy. It's an immensely valuable asset in itself. Valuable enough, remember, that they did a successful IPO for it back in May 2021.
Right, I remember that.
But, and this is the crucial but, maintaining it requires constant, heavy capital investment. Fulfillment centers, specialized delivery fleets, sophisticated technology to manage millions and millions of different products. SCOCIs.
Okay, so that operational control, that massive capital expenditure, that translates directly into the big financial trade-off for JD. Structurally low gross profit margin, or GPM.
Absolutely. That's the deal they've made. While Alibaba's GPM, especially historically, could soar well into the double digits, JD's GPM structurally hovers around, well, just 8%. Maybe a bit more sometimes, but roughly 8%.
Only 8%, that's incredibly tight for retail.
It is. They've effectively sacrificed that higher gross profit percentage to achieve what they believe is the best-in-class supply chain control and therefore customer experience.
So to actually make money, JD has absolutely zero room for error, right? They need massive volume and flawless operational execution just to make that thin margin work.
Near perfect execution is required. They have to compensate for that tight margin with sheer scale and efficiency.
Okay, so if the core trade-off is high margin potential at Alibaba versus operational control and efficiency at JD, let's really dig into that operational excellence JD claims. The metrics seem to back them up, particularly on capital efficiency.
They absolutely do. The crucial metric to look at here is the cash conversion cycle, or CCC.
Explain that quickly for us.
Sure. CCC measures the time it takes for a company to convert its investments in working capital. So, things like buying inventory back into actual cash flow from sales. It's a really powerful gauge of liquidity, operational resilience, efficiency.
Got it. And JD's CCC?
JD runs an incredibly tight ship. Their cycle is remarkably fast, achieving a CCC of just 40 days.
40 days. Okay, no, wait a second. I have to pause there. Because Alibaba is the asset-light platform, right? The digital landlord who doesn't own the inventory. Why on earth is their CCC slower at 60 days? That feels counterintuitive if they aren't bogged down with inventory costs.
That's a really critical question, and it gets right to the nuances of the platform model. It seems strange, doesn't it?
It does.
So while Alibaba avoids owning the inventory, their revenue gets tied up elsewhere, mainly in accounts receivable waiting for payments from merchants, and sometimes they have longer payment terms with their big, high-volume sellers. Plus, just the sheer complexity of their ecosystem, managing thousands of data points, services, different types of transactions. It means the operational cycle for converting their service revenue, their fees and ad money, into actual realized cash just takes longer.
I see. So JD, even though they're asset heavy, they have absolute control over their sales cycle. Product sold, cash comes in much faster.
Exactly. When JD sells a product, they are immediately converting that inventory investment back into cash, much quicker than Alibaba is collecting all its various fees and commissions from thousands of merchants.
So JD's 20-day faster cash cycle isn't just a number. It's a significant liquidity advantage, a form of financial resilience, especially in a tough economy.
Precisely. It means less capital is tied up in the system and for less time. It gives them flexibility. And we see this borne out perfectly in other asset utilization metrics. Look at the benchmarks from fiscal year 2023.
Okay.
Inventory turnover rate. This shows how quickly a company sells and replaces its inventory over a year. JD achieves 9 times.
9 times a year.
Alibaba.
Yeah.
Only 5 times. JD is just moving product faster, which reduces warehousing costs, minimizes obsolescence risk, and lets them react quicker to shifts in market demand.
That's a big difference. And we see something similar in how quickly they collect cash from sales, too.
Yes. Receivable turnover.
Yeah.
JD recorded 8 times, compared to Alibaba's 6 times. Again, it indicates JD is structurally quicker at getting the cash in the door after a sale is made.
Okay.
So collectively, these metrics really reinforce the core idea. Alibaba's structure promises higher potential profit margins, higher leverage when things go well. But JD's model delivers superior day-to-day operational effectiveness and, critically, better cash management.
So as an investor, you're essentially choosing between that potential leverage on one side and proven resilience and efficiency on the other. And that structural efficiency at JD, well, it's being tested now like never before, isn't it? The whole operating environment has shifted radically.
Oh, absolutely. That cozy duopoly these two enjoyed for years, it's gone, shattered, replaced by what people are now calling a fragmented triopoly, or maybe even more fragmented than that.
Triopoly. Who's the third major player disrupting things?
It's the single biggest source of financial pressure right now. The market is being aggressively disrupted by PDD holdings.
Yeah.
You know them as Pinduoduo domestically and increasingly Temu internationally.
Right, PDD. Huge growth story.
Huge. And it's not just PDD. You also have the powerful emergence of short video commerce platforms, especially Duian, which is TikTok's Chinese cousin. They've integrated shopping seamlessly into video scrolling.
So people are buying directly while watching videos.
Exactly. And these new players have just smashed the old price equilibrium. They compete aggressively on price.
So where do the market shares stand now? How fragmented is it really?
Well, the old dominance is definitely eroded. Our sources suggest Alibaba remains the largest player, maybe around 44% market share. JD holds on to about 24%.
Still significant players. Oh, absolutely. But look at PDD Holdings. They've become a monster. They surged to roughly 19% market share by mid-2023. Think about this. That's up from a relatively minor 7.2% just 4 years earlier, back in 2019.
Wow, nearly tripled their share.
And PDD's whole model is built on extreme low-cost group buying, deep penetration into China's lower-tier cities. Places where maybe Baba and JD weren't as strong initially, they're forcing both the incumbents to fight hard on price on PDD's turf.
And this intense fight for market share, it inevitably leads to a crippling price war, right? Heavy subsidies, deep discounts.
Exactly. It's become a discount-driven market in many categories.
How does this price war translate into downside risks, specifically for JD, given that structurally low 8% gross margin we talked about? They don't have much cushion.
For JD, it's an acute threat. I'd even say an existential threat to their near-term profitability. Operating with only an 8% GPM means every single dollar they spend on subsidies or discounts comes directly out of an already very thin potential profit pool.
No buffer. Practically none. When PD forces prices down, especially in categories like electronics or everyday goods where JD is strong, JD has to respond to keep customers. But doing so drastically increases the risk of net income dilution. They just have the least financial buffer among the major players to absorb a prolonged price war.
And we saw that tension in the recent results, didn't we? Even though JD Retail posted a strong Q2 2025 operating margin of 4.5%, which sounds good for a promotion quarter.
It is good, historically, for a heavy promotion quarter like 618. But that hard-won margin is immediately threatened by sustained, aggressive pricing from competitors. It's constantly under pressure.
Okay, so if JD is fighting for survival at the bottom line, how is this affecting Alibaba? They're being forced to sacrifice the very thing that defined them, those historically high margins.
Exactly. You hit the nail on the head. Alibaba is basically hemorrhaging margin to defend its market leadership position. They can't afford to lose merchants or consumers to PDD or Duian.
So what are they actually doing?
They're implementing massive consumer subsidies. They're simplifying our platform pricing structures, trying to make it easier and cheaper for merchants. For example, implementing things like a standard lower 0.6% software service charge in some areas.
That sounds like a direct hit to their service revenue model.
It is. It's a direct sacrifice of those high margins they used to enjoy. It's a necessary defense mechanism right now, they feel, to retain merchants, retain consumers. But the consequence is that it permanently lowers the maximum profitability ceiling of their platform model. The glory days of those super high margins might be over.
Wow. So intense competition. And then on top of that, we cannot forget the permanent structural costs imposed by the regulators. That 2021 antitrust case against Alibaba by Sambara, the market regulator, that was a real turning point, wasn't it?
Oh, the State Administration for Market Regulation versus Alibaba was absolutely a landmark event.
Yeah.
Legally, financially, it changed the landscape. The headline was the record fine, RMB 18.23 billion.
Huge number.
Huge number. Captured headlines globally. But here's the thing. The fine itself, while massive, was actually a relatively small piece of the long-term financial cost to Alibaba.
Really? How so?
Well, analysis from our sources confirms the fine represented only about, say, 1.8% to maybe 4.2% of Alibaba's total long-run valuation loss during that period of intense regulatory scrutiny.
So the market punished the stock far more than just the amount of the fine. What was the real damage then, if not just the cash payment?
The real damage, the long-term structural damage, came from the mandates for change imposed by the regulator. specifically forcing Alibaba to abandon its controversial pick one from two policy.
Ah, the exclusivity requirement. Merchants could only sell on Alibaba, not on competing platforms like JD.
Exactly. Forcing them to drop that exclusivity requirement meant merchants were suddenly free to sell everywhere. That immediately intensified competition, and the direct result, financially, was a sustained 7% to 9% decline in Alibaba's gross profit margins.
7 to 9% permanent hit to GPM.
Permanent structural adjustment. This wasn't a temporary dip. It was a fundamental change to the platform's inherent earning power. It basically ensured competition would be fiercer and margins thinner forevermore. You could call it the permanent regulatory tax that Baba now pays.
Okay, that's a heavy burden. However, on the flip side, resolving that case did remove a massive cloud of uncertainty hanging over the stock, didn't it? And the stock's performance since then has been pretty remarkable.
Absolutely. That's the counterpoint. Once the fine was paid, the structural changes were mandated, and crucially, the major restructuring process got underway at Alibaba. Investors felt they had clarity. They could finally assess the new normal for Baba.
And they liked what they saw, apparently.
Well, they certainly started repricing the stock upwards, significantly. Over the last year, Baba stock delivered an exceptional one-year return of plus 54.2%. And the year-to-date return for our tracking period was staggering, plus 98.7%.
Wow, nearly doubled year to date. That significantly outpaces JD and other peers, right?
Significantly. It suggests that having that regulatory closure, even with the margin hit, was ultimately seen as a positive compared to ongoing uncertainty faced by others.
Okay, one more risk factor to address here, the geopolitical risk. For a while, there was a lot of talk about U.S. delisting under the Holding Foreign Companies Accountable Act, the HFCAA. Is that still a major concern?
That particular risk, the HFCAA delisting risk, seems to be largely off the table now. The major breakthrough came in 2022 when the Chinese authorities granted the U.S. Public Company Accounting Oversight Board, the PCAOB, full, satisfactory inspection access to the audit papers of Chinese companies listed in the U.S.
And that satisfied the main requirement of the HFCAA.
It did. It removed the primary catalyst for forced mass delisting. Plus, both Alibaba and JD were smart. They established robust secondary listings back in Hong Kong.
Right, hedging their bets.
Exactly. So even if minor political friction were to somehow reignite the issue down the line, which seems less likely now, they have deep liquid trading channels available in Hong Kong. So the structural listing risk, while maybe not zero, is no longer a primary investment factor for most people looking at these names.
Good to know. That's one less major worry for investors. All right, now let's really get into the weeds with the latest numbers, the Q2 2025 financial reports. Because these numbers, they really tell the story of the cost of fighting this current competitive war. And JD and Alibaba paint two wildly different pictures, even though they're facing the same pressures.
They really do. Let's start with JD.com. Surprisingly, perhaps, they demonstrated remarkable resilience on the top line. Net revenue growth was robust, up 22.4% year over year.
22% growth is strong. What's the actual number?
Hit RMB 356.7 billion. That's almost 50 billion US dollars for just one quarter. And their core business, JD Retail, also grew strongly, up 20.6%. And as we touched on, they managed to achieve a historically high operating margin for that retail segment of 4.5%, which is impressive for what's typically a big promotion quarter, the 6/18 festival quarter.
Okay, strong revenue growth, record operating margin for the quarter in retail. That sounds excellent on the surface, but you hinted there's a catch. The devil's in the details, particularly this dilution factor.
That's exactly it. That strong revenue growth is almost like a facade, masking some severe financial pain happening underneath, particularly for shareholders. Diluted net income per ADS, that's per share, basically dropped sharply. Plummeted, really.
How bad was it?
It went from RMB 8.19 in Q2 of 2024 down to just RMB 4.15 in Q2 of 2025. More than halved.
Ouch.
And if you look at non-GAAP net income attributable to shareholders, a measure analysts often prefer, that also roughly halved, fell from about RMB 14.5 billion down to RMB 7.4 billion. So the market is seeing record sales volume, but dramatically less profit actually flowing through to each share.
Okay, that immediately prompts the obvious question. If sales are up strongly, and the operating margin in the core retail business is stable, even high for the quarter, what on earth is eating all the profit? Where's the money going?
It's going into massive strategic investments and expenses. And these are aimed directly at defending their position and trying to grow in this brutal new market structure. Two line items really jump out.
Okay.
First, fulfillment expenses. This covers that enormous logistics network, warehouses, delivery, etc. Those costs increased 28.6% year over year. Significant? but maybe expected with higher volume.
Right.
But the truly staggering figure is marketing expenses. These absolutely soared, up an astronomical 127.6% year over year.
127% increase in a single year.
Yes. Marketing expenses jumped to RMB 27.0 billion, which is about 3.8 billion US, just for the quarter.
Wow. 127% increase in marketing. That doesn't sound like a sustainable strategy. It sounds more like a frantic fight for survival, throwing money at the problem. Is that kind of expense surge viable for JD long term?
Well, that's the billion-dollar question, isn't it? That level of spending is clearly an indicator of just how ferocious this price war has become, and analysts are absolutely rightly questioning its long-term viability, especially, remember, given JD's inherently low 8% structural GPM.
They just don't have the margin to sustain that kind of burn rate indefinitely.
Exactly. Now, JD would argue much of this spending is strategic investment. It's tied up in new, potentially high growth, but currently low margin or loss-making business initiatives. A big one is JD Food Delivery.
Competing with Meituan and Eli.me.
Right. They're spending very heavily to scale up this new vertical. They achieved a daily peak order volume of 25 million during that crucial 618 promotion period, which shows traction. But it's costly to build that scale.
So they're effectively mortgaging current profit to buy future market share in new areas, hoping the operational efficiencies kick in eventually and turn it profitable.
That seems to be the gamble. They hope the scale and their logistics prowess will eventually make these new ventures profitable. But it's a high-risk bet given the current spending levels.
Okay, let's turn the spotlight to Alibaba now. Their top-line story in Q2 was much slower, wasn't it? But their investment priority seems entirely different, focusing on high-tech infrastructure rather than just pure market defense spending like JD.
Yeah, a very different picture at Alibaba for Q2 2025. Consolidated revenue growth was significantly slower, just 2% year over year on a reported basis.
Only 2%. That's quite a slowdown.
It is. Now, to be fair, if you exclude the revenue from some non-core assets they disposed of, the underlying growth was a more modest but still not spectacular 10%. And adjusted EBITDA, which is a key measure of operational profit, actually decreased by 14%.
Decreased 14%. Okay. But I noticed their GAAP net income, the standard accounting profit, actually increased by 76%. Isn't that a positive sign? Doesn't that contradict the EBITDA decrease?
Yeah, you have to be careful with GAAP net income sometimes. It needs context. That big 76% jump in GAAP net income was largely non-operational. It wasn't driven by the core business doing better.
So where did it come from?
It was driven primarily by mark-to-market gains on their equity investments. So the value of stocks they own in other companies went up, and also from the proceeds they got from selling off some non-core businesses, like the local consumer service segment of Trendyol, their Turkish platform.
Okay, so financial engineering and asset sales, not core operations improving profit.
Pretty much. The true story of their operational performance and strategic choices is much better reflected in their cash flow. And that's where you see the massive sacrifice happening at Alibaba right now.
Right. Which brings us to their free cash flow number.
Yeah.
Which swung dramatically from positive to a huge outflow.
This, I think, is the headline financial story for Alibaba in Q2 2025. Free cash flow plunged. It went from a positive inflow of RMB 17.4 billion in the same quarter last year.
Healthy number.
Very healthy, to a negative outflow of RMB 18.8 billion. That's about 2.6 billion US dollars in this reporting quarter.
A massive negative swing. Why? What caused such a violent reversal in cash flow?
It was almost entirely attributed to one thing: a deliberately accelerated massive increase in capital expenditure, or CapEx. Their CapEx for the quarter was RMB 38.6 billion.
38.6 billion RMB. In just 3 months. How does that compare to usual?
It's a huge increase. In the same quarter last year, their CapEx was just RMB 11.9 billion. So they more than tripled their capital spending year over year.
RMB 38.6 billion is roughly 5.3 billion US dollars. Spending that much on CapEx in a single quarter is an enormous, almost staggering figure. We need to be crystal clear about where this capital is going because this represents a fundamental strategic decision by Alibaba.
Absolutely, and they've been quite clear about it. It is going directly into securing what they believe is their long-term position as a dominant technology leader, not just an e-commerce platform.
Okay.
The investment is focused squarely on two key areas. First, building out high-performance AI infrastructure, think servers, chips, data centers needed for artificial intelligence. And second, building out their cloud computing infrastructure.
AI and cloud.
AI and cloud. And alongside that, accelerating investment into their newer e-commerce initiative, Taobao Instant Commerce.
So unlike JD's spending, which seems largely defensive marketing and scaling adjacent businesses like food delivery, Alibaba is consciously sacrificing short-term cash generation, short-term profit to pour concrete and buy servers.
That's a good way to put it. They are betting that the future high margins won't come from basic e-commerce anymore, but from providing the underlying computing power and AI services that everyone else will need. This isn't about defending current market share in Tmall. This is betting the company, or at least a huge chunk of capital, on entirely new, potentially higher margin revenue streams for the future.
Okay, so given these massive but very different financial commitments we just discussed, the strategic paths these two giants are taking couldn't be more divergent, could they? Alibaba is pursuing this, well, high-risk, high-reward offensive strategy, going all in on AI and cloud.
That's the narrative, yes.
While JD seems much more focused on a defensive strategy, leveraging and enhancing its core operational moat, which is logistics and retail efficiency.
That's a fair summary. Alibaba's commitment to AI and cloud really is the centerpiece of their future vision. They've publicly committed to investing a massive RMB 380 billion, that's over $50 billion US, over just 3 years into this AI and cloud infrastructure.
380 billion RMB over 3 years. That's serious money.
It's an enormous bet. It represents a deliberate attempt to diversify away from the increasingly brutal, lower-margin competition in core e-commerce and transition into becoming a global high-margin technology provider, selling picks and shovels for the AI gold rush, essentially.
It's a bold pivot, but are these enormous investments producing tangible results yet? Or is it still mostly promissory, just spending money with hopes for the future?
No, they are definitely starting to show some solid early momentum, according to their reports. The Cloud Intelligence Group, that's their cloud division, saw its revenue growth accelerate significantly in Q2, up 26% year over year.
26% is strong growth.
It is. And importantly, the revenue from external customers, so not other Alibaba divisions, but third-party companies buying their cloud services, grew at the exact same robust 26% rate.
That's key. Shows real market traction.
It does. And they directly link this acceleration to the growing demand for AI computation power. Even more explosively, they highlighted that their AI-related product revenue has maintained triple-digit growth for 8 consecutive quarters now.
Triple-digit growth for 2 years straight.
8 quarters straight.
All right.
And AI-related products now apparently account for over 20% of the total external cloud revenue.
Okay, that's the kind of growth metric that gets growth investors excited. That's what they're buying the premium valuation for. And Alibaba is trying to position itself not just as a cloud provider, but as a comprehensive full-stack AI player.
Exactly. That's the goal. They want to be a full-stack AI provider, offering everything from their own proprietary chips and the raw computing power, all the way up to large language models and AI application services.
So controlling the whole value chain.
Trying to. They're heavily promoting their own open-source models, like Qwen, to build an ecosystem, and they're forming key strategic alliances with big global players. For instance, they highlighted a partnership with SAP.
The big enterprise software company.
Right. The deal is that SAP will use Alibaba Cloud infrastructure to enable its enterprise customers in certain regions to run their core SAP software systems. And SAP will also leverage Alibaba's Qwen AI models to offer AI transformation services to those clients.
Interesting. Integrating AI into core business processes via SAP.
Yeah. And they're ensuring global reach, too, mentioning expansions and new partnerships in high-growth regions like Brazil, France, Mexico, Japan. It's a global technology push.
Okay, so that's the big AI cloud offensive. What about on the traditional commerce side? They also did a major restructuring recently, designed to create a more unified consumption platform, feeding into this quick commerce trend.
Yes, that was significant too. The organizational restructuring announced in August 2025 aimed to simplify their complex structure. They consolidated into 4 major business groups. The key move for domestic commerce was consolidating their core platforms, Taobao, Tmall, the local delivery service Ele.me, and even the travel platform Fliggy, into one single cohesive unit called the Alibaba China e-commerce group.
Why do that? What's the strategic rationale?
The idea seems to be to create a more unified, maybe stickier super app platform, a place where consumers can move seamlessly between traditional online shopping on Taobao Mall, ordering food delivery from Ele.me, and maybe booking travel on Fliggy, all within one integrated experience. Break down the silos.
And how does this feed into Taobao Instant Commerce, their answer to the demand for, stuff delivered in 30 minutes or an hour?
This unified structure is meant to directly support and accelerate Taobao Instant Commerce. By integrating Ella.May's delivery network and local merchant base more tightly with Taobao, they can better compete in that ultra-fast delivery space.
And is that investment showing results? Quick commerce is hyper-competitive, too.
Well, the investment here, according to their numbers, is showing rapid scalability, at least in user adoption. They reported that Taobao Instant Commerce has achieved some phenomenal growth milestones recently, reaching nearly 300 million monthly active consumers.
300 million? How does that compare?
They claim that represents 200% growth just since April of this year. So very rapid ramp up. And they say this push directly contributed to a 25% year-over-year increase in overall Taobao app monthly active consumers in the first few weeks of August.
So it's bringing more users to the main app.
That's the idea.
Yeah.
And management has set a very ambitious long-term goal for this.
Yeah.
They're aiming to generate RMB 1 trillion, that's about $140 billion US, in incremental gross merchandise volume, GMV, specifically from instant commerce within the next 3 years.
1 trillion RMB incremental GMV. That's a huge target. Shows how important they think this quick commerce battleground is.
Absolutely. It's clearly a major strategic focus alongside AI and cloud.
Okay, now let's pivot back to JD.com. Their strategy, as we said, feels much more grounded in operational defense, leveraging their existing strength, that massive logistics network.
Yeah, JD's strategy is definitely maybe less glamorous than AI, but it's deeply tactical and focused on their core competency. It really centers on enhancing their retail operational superiority, primarily through continuous improvements in JD Logistics, JDL, reinforcing that integrated logistics moat.
So less about building entirely new businesses, more about making the core retail and logistics engine even better.
Largely, yes. This involves deploying ever more advanced technology within their fulfillment centers. They highlighted things like their proprietary Zlang intelligent warehousing system.
What does that do?
Apparently, it enables extremely high-density storage, saving space, and can complete complex order sorting tasks, picking items from many different orders simultaneously in just a matter of seconds. Even when managing tens of thousands of different SKUs in the same facility, they are constantly trying to squeeze every last drop of efficiency out of that physical network.
Using tech to optimize the physical world.
Precisely.
And they aren't just focusing domestically, are they? They're taking that core logistics expertise global. That seems like a significant strategic move for JDL.
It is. JD Logistics is strategically expanding what they call their global smart supply chain network. They now operate, according to their reports, over 130 overseas warehouses spread across 23 countries.
So building physical presence abroad.
Yes. And a concrete example they gave is the recent launch of their own self-operated express delivery brand called Joy Express in Saudi Arabia.
Saudi Arabia, interesting market.
Very strategic market in the Middle East. They're aiming to establish a comprehensive, end-to-end localized logistics network there. Warehousing, customs clearance, last-mile delivery, all under their own brand and control, replicating their domestic mode abroad, essentially.
That takes serious investment, too, though perhaps less headline-grabbing than AI chips.
Absolutely. Building international logistics is capital-intensive.
Okay, logistics defense and expansion. What else is core to JD's strategy right now? We talked about the spending pressure from new initiatives like food delivery.
Right. They're still pushing those new businesses, like JD Food Delivery, trying to achieve scale. They highlighted the 25 million peak daily orders during 618 as evidence of progress. But the other major pillar of their current strategy, and a massive differentiator from Alibaba's cash outflow situation, is their strong commitment to shareholder returns.
Yes, the share buybacks. Tell us about that. How significant is it?
It's very significant, especially in the context of their valuation. It signals management's confidence, or at least their desire to project confidence, in the stock's current low price. They authorized a substantial new share repurchase program, $5.0 billion running through August 2027.
$5 billion. That's a lot of buying power.
It is. And critically, this program isn't being funded by taking on more debt. They emphasize it's funded directly by the superior operational cash flow generated by that rapid 40-day cash conversion cycle we discussed earlier.
So using their operational efficiency to directly reward shareholders and support the stock price.
Exactly. And they're acting on it. They repurchased $1.5 billion worth of their own shares in just the first 6 months of 2025 alone.
$1.5 billion bought back already.
Yeah. When a company's management is buying back stock at a rate like that, especially when the price is depressed, they're making a very public declaration. They're essentially saying, we believe the market is severely underestimating the intrinsic value of our company. It's a strong signal.
Okay, so let's bring it all together for the investor's perspective. If we look at the investment landscape today, the valuation disparity between these two companies is just staggering. And it perfectly encapsulates the market's deep uncertainty about which model operational efficiency or structural margin potential will ultimately prevail in this tough environment.
The contrast is incredibly stark right now. Let's look at JD.com first. Based on analyst consensus estimates for its earnings in 2026, JD.com trades at a forward price-to-earnings ratio, or PE, of less than 9 times.
Less than 9. For a major tech player, even with the challenges, that seems incredibly low.
It is. It's practically textbook definition of a deep value multiple, especially when you consider that the same analysts are forecasting, maybe optimistically, a very strong earnings growth rate of 40% year-over-year for JD in 2026.
Wait, a forward PE below 9, but with a 40% projected earnings growth rate for the following year. That sounds fundamentally mispriced. Why would the market assign such a deep discount? What's the catch?
That massive discount reflects the market's profound pessimism, really, regarding the sustainability of JD's profit margins and that growth forecast.
Yeah.
Investors are clearly worried about 2 critical bear risks we've discussed.
Okay, what are they again?
First, that persistently low structural gross margin of around 8%. It leaves absolutely zero margin for error in execution, or if the price war intensifies further, any slip-up directly hits the bottom line hard, very vulnerable. And second, the high cost of fighting this defensive price war, which we saw explode in that 127% surge in marketing expenses. The fear is that this kind of spending becomes permanent, continuously diluting net income, maybe forcing management to lower future guidance and making that 40% growth target look unrealistic.
So a PE below 9 implies the market either simply doesn't believe that 40% growth is achievable, or it believes the risk associated with JD's low margin structure in this competitive environment is just too high to warrant a better multiple. Or maybe both.
Precisely. It's pricing in a lot of potential negative outcomes.
Okay, now in complete opposition, let's look at Alibaba. It trades at a significantly higher forward PE. What's the number there?
Alibaba's forward PE, based on 2026 estimates, is around 19.57x, so more than double JD's multiple.
19.5 times. Still not crazy high for a tech growth story, perhaps, but a world away from JD's single-digit multiple. Why does Alibaba command such a premium, especially given its slowing e-commerce growth and the recent cash outflow?
That premium exists because the market is clearly assigning substantial future value to really 2 core structural advantages or potential advantages that Alibaba possesses.
Okay, what are they?
First, the inherent historical leverage of its high-margin, asset-light platform structure. Even after the regulatory hit reduced those margins, the potential ceiling for profitability is still structurally much higher than JD's 8% GPM world. If competition ever eases, Baba's profits could theoretically rebound much more strongly.
The platform leverage potential.
Right. And second, the market is clearly putting a significant value on those massive strategic growth vectors we talked about, particularly the high risk but potentially very high reward bet on AI and cloud leadership.
So investors are paying a premium today for the possibility of much higher profitability tomorrow, driven by tech, even if it means negative cash flow today.
That seems to be the narrative the market is buying into right now. They're looking past the current spending and margin pressure towards a potentially lucrative AI-driven future.
And the recent stock performance we mentioned certainly confirms the market's preference for Baba's premium growth story over JD's deep value story, doesn't it?
It absolutely does, at least for the period we tracked. That exceptional momentum in Baba's stock, the plus 98.7% year-to-date surge, confirms that investors aggressively repriced the stock upwards once the regulatory overhang was resolved, and the company clearly articulated its aggressive commitment to AI and restructuring. The narrative of future tech growth, despite the current free cash flow outflow, is clearly winning out in investor sentiment over JD's narrative of operational efficiency and deep value, at least for now.
Okay, let's try and crystallize these 2 very different investment choices for you, the listener. The JD thesis, it really boils down to being the defensive value play.
Exactly. The investment case for JD is primarily a defensive statistical value argument. It's probably best suited for value-oriented portfolios, investors who prioritize proven capital efficiency banking on that 40-day CCC, and are looking for a substantial valuation multiple expansion if, and it's a big if, management can successfully deliver on that ambitious 40% forecasted earnings growth for 2026 while somehow navigating the price war without destroying margins completely.
And the bear risk, the thing that keeps JD investors up at night.
The clear bear risk is its acute vulnerability. Sustained, market-wide price erosion driven by PDD and others could lead to ongoing severe net income dilution, making that growth target impossible and potentially forcing the company into difficult choices.
Okay, that's JB. Now, the Alibaba thesis. This is the high leverage growth bet.
Absolutely. This is squarely for growth investors. For those willing to tolerate the current significant short-term cash flow sacrifice in exchange for potentially much higher future rewards. The bet is on the successful realization of value from that enormous RMB 380 billion investment in AI and cloud. And also on the eventual recovery and re-leveraging of their core platform margins, assuming competitive pressures eventually somehow stabilize or ease off.
And the big risk for Alibaba holders, what could derail that growth story?
The primary bear risk is that the competition doesn't ease off. It's the continuation or even intensification of aggressive gross profit margin erosion caused by PDD and Duian. If that happens, it could permanently undermine the historical profit advantage of the platform model, compounding the structural costs already imposed by the regulatory mandates. The fear is that the high margins never fully return, and the AI cloud bet takes too long or costs too much to pay off. Hashtag tag outro.
So this deep dive really highlights two Chinese tech giants pursuing radically different survival and growth mechanisms right now. JD.com is hunkering down, focusing on what it does best: operational efficiency, leveraging its formidable logistics control, managing cash incredibly well. It makes it a compelling statistical value play, but one that is currently deeply discounted, maybe for good reason, by the market.
Right. And Alibaba, conversely, is relying on its historical structural advantages, the platform model's potential, but has made this massive high-risk, high-reward strategic pivot into AI and cloud. It's sacrificing significant short-term cash flow today to try and secure a high-tech, high-margin future tomorrow.
Oh.
And both, we have to remember, are managing the immediate, painful financial impact of this brutal price war in their core markets.
So the ultimate decision for you, the investor, it really seems to hinge on your own risk tolerance and your view of the future. Do you choose the proven operational efficiency and deep value proposition of JD, accepting the margin risk? Or do you choose the potential structural profitability and the massive technology growth bet offered by Alibaba, accepting the execution risk and the current cash burn?
Which brings us right back to the fundamental question that's really facing China's entire e-commerce landscape today. While Alibaba's platform structure theoretically promises a much higher peak profitability, and again, it's a big if the hyper-competitive environment eventually stabilizes. JD.com's proven operational efficiency, its defensive logistical moat, and its currently compellingly low valuation multiple might actually offer a fundamentally more favorable risk-reward profile right now in today's fiercely competitive and incredibly capital-intensive market environment.
So the final provocative thought for you to consider: which company's moat will ultimately prove more resilient against this relentless onslaught from PDD and Duian? Is it JD's integrated defensive logistics network built on physical assets and efficiency? Or is it Baba's potentially much more lucrative but also high cost and perhaps less certain high leverage technology platform bet?
Answering that question correctly is likely the decision that will define returns in the Chinese tech sector for the next 5 years. It's a fascinating battle to watch.